How the factors that led to the 2008 financial crisis relate to today's economy. In 2008, the world was hit by a major financial crisis that shook the global economy to its core. Millions of people lost their homes and savings, and the crisis caused widespread unemployment and economic downturn. But what caused this crisis? And are we seeing the same warning signs now, going into 2023? The 2008 financial crisis was one of the worst economic meltdowns in history. It was caused by the collapse of a housing market marked by abundant financing, low interest rates, little regulation, and unreasonable mortgages. Defaults on such risky mortgages are cited by economists as the primary cause of the crisis. Banks closed their doors to creditors, leading to a global credit crunch. However, there are also other factors and widespread failures that acted as catalysts for the 2008 financial crisis. The thing is, while history does not exactly repeat itself, it does tell a story. Thus, financial regulators have been doing their best to revamp the financial regulatory apparatus and invested in stress tests on the economy since the 2008 economic meltdown. Unfortunately, it is still a hard job to rule out the possibility of another financial crisis similar to that of 2008. In fact, the factors that led to the 2008 economic crisis are beginning to show in today's economy. The imbalances in the economy are so huge that we seem to be headed for another financial turmoil. More than a decade later, the global economy is staring at another financial disaster. An in-depth analysis of the global economy reveals weak points that paint a picture of the years leading to the 2008 financial crisis. Today, we will look at how the factors that led to the 2008 financial crisis are manifesting in today's economy. 1. Some of the issues that led to the 2008 financial crisis remain unsolved. Today, more than a decade after the 2008 crisis, there are still structural issues that could take us down the same road again. Some of these worrying factors include a potential collapse of China's debt bubble and the failure of the Eurozone. Also, other concerns inherent in the aforementioned financial crisis are still harming today's economy. For example, policies put in place in response to the economic crisis simply cover up the problems rather than address them. 2. High-risk investments. In the decades leading to the 2008 financial crisis, the global economy showed such a positive outlook. This led to high-risk investments because everyone expected the economy to keep growing, including investments in the housing market. Unfortunately, homeowners defaulted on their loans and home foreclosures became commonplace. Today, it seems that the world has forgotten how risky investment behavior sparked the 2008 financial crisis because investors are at it again. Unbridled optimism on the economy's outlook has seen the adoption of risky leveraging strategies and aggressive investments, especially among risk-loving investors. Many of their risky investment decisions are made with little to no moderation. While it's true that more risk translates to more profit, this is not always the case. Things can go south just as easily as they can go your way. Too many high-risk investments by so many investors are a ticking time bomb. If some unexpected conditions were to force most of these high-risk investments into losses, the effects would reverberate across the economy. This could lead to a financial crisis similar to the one that was precipitated by a crash in the housing market in 2008. 3. Dwindling trust in the financial system. The global financial and banking systems played a huge role in bringing about the 2008 financial situation. Institutions lost trillions of dollars in the form of assets in the months leading up to the crisis. This led to a sharp decline in the trust that people have in them. Conversely, the lack of trust in the banking system has dire consequences because they are essentially the pillars of the financial system. Today, the world is once again losing trust in the global financial system. Even after radical reforms implemented in the years following the 2008 financial crisis, enough is yet to be done for the world to fully trust the system again. In fact, the situation is so bad that the cryptocurrency system is being proposed as an alternative to the current financial system. While it is still too early to determine whether it's the right way to go, cryptocurrency supporters continue to make some valid points. This is only making more and more people lose trust in the global financial system. 4. Currency wars. There were reports of currency wars before the 2008 crisis. Major economies were doing their best to position their currency higher. The US was also rumored to interfere with the currencies of some emerging markets. Now, the world's largest economies seem to be embroidered in an ever-evolving supremacy battle. Sometimes, this competition is good because it leads to higher quality products, better wages, and affordable prices. However, when unregulated, or if one country decides to use sneaky methods to beat its competitors, another financial crisis might just come to life. 5. It seems business as usual for the financial system. Great caution was taken when developing proper policies post the 2008 financial system. However, the same banking and financial systems that caused the crisis were also key players during the recovery period. Thus, just over a decade later, it appears the global financial system is loosening its belt. Instead of doing more to create a better financial system, it seems like they are just doing business as usual. This can potentially lead to a repeat of the 2008 financial crisis. An economic crisis in 2023 would have more impact than the 2008 financial crisis. There is now less room for policymakers to respond to an economic crisis. For example, the low interest rates of the Federal Reserve would make it hard for them to offer a significant monetary boost. Other complications include the high government deficit and imbalanced debt to GDP ratio. Furthermore, trust in international financial systems has eroded over time, making it difficult to orchestrate a worldwide response at this time. Conclusion: while the factors that fueled the Great Recession are still debated today, it stands as a cautionary tale of the dangers of reckless Wall Street behavior, uninformed investments, and lack of trust in financial regulatory authorities. One thing is for sure: the 2008 financial crisis was avoidable, and so is the looming economic crisis that threatens the world. Like and subscribe for more financial videos, news, and updates. Till the next one.